Okay, now picking up with LIFO. LIFO again is last in, first out, which means that this is the exact opposite of FIFO, and that our cost of goods sold number is based on our most recent purchases or our newest things, and then our ending inventory number is based on the oldest items. So again, as long as prices are going up, this would be higher and this would be lower than with FIFO. So this one is showing you that same one that we've been doing. So we'll have shelf A is the things that cost $350, and we start with 2 of those. Then we made a purchase here. So new purchase, new shelf. These are things that cost $360, and I have 4 of those. So now here's shelf A and here's shelf B showing what I have. Then I made a sale, and so then since this is LIFO, I'm going to be pulling the newest stuff first. That's shelf B. So I will pull 4 units from there, and that's all I need for my sale. So all 4 units came from shelf B, which is the $360 stuff. What's left, and so 4 times 360 gives me my cost of goods sold. What's left is the 2 units here on shelf A, these 2, and those cost me $350, so I have $700 left. Then I made another purchase. So new purchase, new shelf. These are things that cost me $380 each, and I bought 12 of those. So now what do I have? I have the 2 from shelf A, shelf B is empty, and I have 12 units on shelf C. So then I make another sale and I'm selling 10 units. So I start, I'm going right to left this time, right? I'm going this way, the newest stuff first. And so I need 10 units. I can pull all 10 of those from shelf C, and so I have 2 left. So all 10 items came from shelf C, which it costs $380. So my cost of goods sold is $3,800. I have 4 units left. I still have the 2 on shelf A, so I carried that down. And then I had 12 units on shelf C. I took 10 out, so I have 2 left here on shelf C. So you can see that the cost of goods sold is higher and the ending inventory is lower because I'm pulling the most expensive things, the most recent purchases here in my cost of goods sold. So if we go back to the same problem with the bikes that we did with specific identification and with FIFO, and now we're going to do it with LIFO. So I start out, date, purchases, cost of goods sold, ending inventory. So I start out here with 25 bikes that cost me $36 each. So 25 bikes that cost $36 each. 25 times 36 is 900. Those are shelf A, the $36 things, and I have 25 items there. Then on the 16th I make a purchase, and I purchased 35 bikes at $60 each, so 35 times $60 each is $2,100. New purchase, so I put those on a new shelf. These are things that cost me $60, and I have 35 of those. So now I do, okay, what's left? I bring these guys down, so I still have the $25, or the 25 items that cost $36 each for $900, and then my new purchase, 35 times 60, so $2,100. And that's the same as the last 2 that I did. But now the purchase is where it's going to get different. I need 33 items. So where am I going to go? I'm going to go to the right and work my way left. So I'm going to start here. These are my newest purchases, so I'm going to start there. I'm going to pull the 33 items I need for this order. That'll give me 2 left. So all 33 items came from shelf B, so that's stuff that cost $60. And so that is $19.80. And then what's left? The 25 items on that shelf A are still here. So 25 times 36, $900, that's still here. And then I had 35 items, I sold 33. I have 2 left from this group of things that cost me 60, so that's 120. And so, oh, that's the 731. And then the totals, 35 units, $2,100. That's the same. It's still 33 units, but now the cost of goods sold is $19.80. I still have 27 units left, but now the ending inventory is 1040. Sorry, that's 20. Oops. I don't know what you're doing. 27 at 1040. So you can see my cost of goods sold went up and my ending inventory balance went down compared to FIFO. And the journal entry looks exactly the same as the other one. I just changed the number in the last part there, the cost of goods sold. So the purchase will look exactly the same. The sale will look exactly the same. It's just when I debit cost of goods sold and credit merchandise inventory, it's for $19.80. And then the last method we want to look at is weighted average. So with weighted average, I put them all on the same shelf. I don't keep the different purchases separate. I just throw it all into a new bin. And so what I have to do, so when I do a sale, I don't have to say this many came from this group and this many came from this group. They're all just coming from one group. But I have to calculate a new average cost per unit each time I make a purchase. So after every purchase, I will recalculate this average cost per unit. And so your cost of goods sold and your ending inventory will both be based on the same average cost per unit. So it's going to fall somewhere between FIFO and LIFO. It's just going to split the difference between the two. So let me show you how that works. On this one here, I started with my 2 units at $350 each, so I have $700. Then I made a purchase. I purchased 4 units at $360 each for $1440. So when you do the total, this is how you calculate the new one. So first I say I started with 2 units, I added 4 units, so I have 6 units. So we can do that one first. Now I leave the unit cost is the last thing I figure out. So I can do the total quantity and the total cost. I started with 700. I added 1440 more. So those two together equal 2140. Now I figure out the unit cost, which is, so I had $700 worth of stuff. I made a purchase of $1,440 worth of stuff. So now I have $2140 is my total. I divide that by the number of units I have. I have 6 items on hand. So that numbers will probably actually get confusing. Let's do it this way. I do this one first, not fist. Figure out this one first, figure out this one second, and then figure out this one third. Now I take the total inventory in dollars divided by 6 units, and I get $356.67 is my average cost per unit. That goes right here. So the new total cost divided by the new total units gives me the average cost per unit. That's the number that I use here. So when I sell 4 units, I don't care shelf A, shelf B, any of that. It's all in one thing, and I'm just, even though none of them actually cost $356, I'm just going to apply that to everything. So what's left is 2 units, and again, I use that same average cost here. Now I need another purchase. So you can hear I had $713 worth left. I purchased $45.60. So now the total I have is $52.73. I divide that. I had 2 units. I bought 12 more, so I have 14. So $52.73 total divided by 14 units gives me an average of $376.64. So the next time I make a sale of 10 units, this is the number that I plug in here. There we go. And I had 14 units. I sold 10, so I have 4 left, and I just use that same $376.64. So the sale part of it's easier. It's just you have to remember every time you make a new purchase, you have to calculate that new average cost per unit. And then you'll keep on using that average cost per unit until you make another purchase. So for this one, I'm going to sorry about that. I'm going to take, well, it's the same one with the bikes. Date. Purchases will look the same no matter how I do it. Cost of goods sold, and then my ending inventory. So on 7/1, I started with 25 bikes at $36 each. So 25 bikes, 36 each. That's 900. Then I made a purchase. On 7/16, I purchased 35 bikes at $60 each for $2,100. So now I had 25 bikes. I bought 35 more. I have 60 bikes total. I had $900. I have $2,100 now, so I have a total of $3,000 worth of bikes. $3,000. So I had 900. My purchase was 21. I have $3,000 worth of bikes divided by 60 bikes gives me an average of $50 per bike. So I fill that average cost per unit in last. Now on the 31st, I'm going to make a sale. I'm selling 33 bikes, and I'm going to use this $50 per unit for all of them. So that's $1,650 is the cost of goods sold. What's left? I had 60 bikes. I sold 33 of them. I have 27 bikes left. I'm just going to average out and say they all cost $50, and so that is $1,350. So then my totals, 35 and 2,100, that's the same. Still 35 bikes sold, but now the cost of goods sold is $1,650, which falls in between FIFO and LIFO. Still 27 bikes left, but now the inventory value is $1,350, which again falls somewhere between FIFO and LIFO, and the journal entries would look the same. So using the example in the book, if we look at the impact on the income statement, so the sales revenue is the same regardless of which method I use. But you can see that the method I used makes a big difference on cost of goods sold and therefore on gross profit. So with FIFO, I have a lower cost of goods sold, which means I have a higher gross profit. So that looks good, right? A high gross profit looks good. Let's say I want to attract investors. LIFO has the highest cost of goods sold, which means it has a lower gross profit. So that doesn't look as good, but if I have a lower gross profit, have a lower operating income, this means I have lower taxes. And so you can see that they each have different benefits. It's not one's right and one's wrong, but they definitely have an impact on your gross profit and then for your income or on your expenses and your taxes. On the balance sheet, the beginning inventory, the purchases is the same, and so the goods available are the same, but what I took out is going to be different. So with FIFO, I took less out, so I have a higher ending inventory. With LIFO, I took more out, so I have a lower ending inventory. And these are the numbers on the balance sheet. And again, the weighted average will always be somewhere in the middle. Specific identification, it really depends which ones you sold. So this is going to make your FIFO is going to make your assets look higher. LIFO is going to save you some money in taxes, but it's going to make your profit and your assets look a little bit lower there. So this is a summary of the demo problems that we did. So this one was the specific identification. This one was the FIFO. This one was the LIFO. And this was the weighted average. And so if we look at these, we can see the same thing. So cost of goods sold was $13.80 for FIFO, up to $19.80 for LIFO, and somewhere in the middle here for weighted average. Because this cost jumped up a lot, right, from 36 to 60, the higher the costs are rising, the bigger the difference you're going to see here in the cost of goods sold between the methods. The more inventory and the faster prices are going up, the bigger the difference you're going to see here. Inventory on hand, 1,500, 1,620, oops, I don't know why I didn't put that down there, down to 1,020, so 1,000 for LIFO, and in the middle there again for weighted average. And so again, I've got this $600 difference between the two, which is the same as the difference in the cost of goods sold. So the more inventory you have, and the bigger the difference in the cost, the more dramatic a difference you're going to see depending on which method you use. I'd also like to show you lower of cost or market. And this is, at the beginning we talked about the different principles that apply to this, and one of them we talked about was conservatism. And so this is conservatism in action right here. And this rule says that the inventory balance that is reported on your financial statements will be whichever is lower, cost or market. Hence the name, lower of cost or market. So the cost is the historical cost. This is what is on your books in your ledger account for merchandise inventory. This is what you paid for it. The market is the current market value or the replacement value. If you were going to restock this inventory, what would you pay for it? And so what I want to report on my balance sheet is whichever one is lower. So I find out the cost is in my ledger account now, I find out what the market value is, and then I report the two. If cost is lower, no adjustment is needed. You're already reporting the lower one. No adjustment needed. If market is lower, and that's then I need to write down the inventory. I need to write down the inventory for the difference, and that is the difference, the cost minus the market. And that looks just like when I did for the inventory shrinkage in Chapter 5. So I debit cost of goods sold, I credit merchandise inventory for the difference between the two. So let's look at one of those. This is showing me after a couple transactions, this is what I had. The merchandise balance on hand. So this is the cost to me. This is the current replacement value, so that's the market. So right now the cost is already lower than the market, so there's no adjustment needed. And the balance that's going to be reported on the balance sheet is cost. The cost is already reported, so the $380 is what's reported on the balance sheet. I think that's a terrible problem because it doesn't actually show you how to do one. So let's what if let's say what if the replacement value instead of the 431, let's say it's 350. Then the market is lower than the cost, and I need to do an adjustment. And so I want to bring that 380 down to 350. So I debit cost of goods sold and credit merchandise inventory for the difference between the two, so $30. And if I do that, this is what's currently showing on my ledger account. I credit it $30, that will bring it down to $350. And so now my ledger account will be showing the $350, which is the lower of the two. And the last thing I want to show you in here is some financial ratios that are very, very important to merchandisers. The first one is inventory turnover, and this is calculated as cost of goods sold divided by average merchandise inventory. And anytime you see average in these financials, that always means you take the beginning balance plus the ending balance divided by 2. And inventory turnover, a higher number is better. It kind of says, if you pretend like you don't restock your inventory until you sell everything in your storeroom, then that says I sold everything and restocked that number of times. That's what that tells you. Then once you get that, you can do days sales and inventory, which is 365 divided by that inventory turnover number that you just calculated. And for this one, lower is better. This tells you how many days it's on average an item sat here before it was sold. And you want to minimize that. You want to turn this stuff over as fast as you can to maximize your profit. So for this one, we're going to calculate both. So inventory turnover is cost of goods sold divided by average merchandise inventory. So cost of goods sold is 19,000. Average merchandise inventory. So I take the beginning plus the end divided by 2 to get an average of those. So I'll take 600 plus 460 divided by 2. So that gives me 19,000 divided by 530. So I get 35.85 times. Again, these are the demo problems that I have set up for you in my lab, so you can you can work those along with this if you want to go back and do these on your own. But this tells me that I sold everything and restocked almost 36 times in whatever period of time this is, a year, I don't know. And then once I have that, I can do days sales in inventory, which is just 365 divided by my inventory turnover, which is 35.85, and I get 10.18 days, which says on average things sat here for 10 days before I sold them. And so again, these numbers are more meaningful if you have something to compare it to. So you could benchmark it against your competitors, or more likely what you're going to do is watch it yourself over time to see if you want this number to be going up and you want this number to be going down. And that's kind of your goal there. So that's chapter 6. Let me get this one posted for you.